Hello, everybody, and thank you for joining us today on DST Essentials with K Properties and Investments. In-depth look at all things Delaware statutory trusts and 1031 exchanges. Before we dive into today's topic, just a quick housekeeping item. This material is not tax or legal advice, so please speak with your CPA and attorney for tax and legal advice. All offerings discussed, if any, are Regulation D Rule 506C offerings, which are only available to accredited investors generally described as having a net worth of over $1 million exclusive of their primary residence. Please verify with your CPA and attorney if you qualify as an accredited investor or entity. This information is educational only and is not offered to purchase securities or DST properties. Such offers are only made through a private placement memorandum, which investors are encouraged to read in full. Past performance does not guarantee future returns. Diversification does not guarantee profits or protection against losses. Returns are never guaranteed and could be lower than anticipated. All real estate and DST properties may go up or down in value. Securities offered through FNEX member FINRA SIPC. FNEX and K Properties are separate entities. So now we can dive into the meat and potatoes of today's conversation.
That's right.
I have Tim Emanuel, one of our vice presidents here at the company, and myself, Shay Lappin, president of K Properties and Investments. And today we're going to dive into or have a conversation about 721 exchanges, because I think a lot of people are starting to hear more and more about that strategy.
That's right.
And we just ultimately want to have an opportunity to walk through the pros and the cons, especially in something that's so new to the individual or having access as an individual investor to that strategy. It's a very complex strategy, and that's why we're going to talk today very high level. There is a lot more nitty-gritty that we could get into on each of the different things we're going to hit today.
Definitely.
But I do encourage you, set up a call, especially with Tim and his team, because they dive into all of the public filings of these REITs or non-traded REITs to get this information. So this is public information. This is not us doing a hypothesis or a guess.
That's right.
This is factual information that each of these vehicles are required to file on a quarterly basis. So anyways, real fast, I guess a two-part question.
Sure.
Since you're on the front lines talking with clients every day,
Yep.
How often is the 721 exchange strategy coming up? And can you quickly explain what the 721 is in the DST world?
Sure. No, it's a very important conversation that we're getting asked about quite a bit more than we were. And I think if we talk to a lot of the industry veterans, you'll hear it's pretty common for folks to, express that this is something that we did not, and our investors did not have much use or interaction for up until just a few years ago. And it's really become a trend that we're starting to see, and there's some concerning factors about it that K Properties is taking seriously to dive into. Because with any new trend, with any new investment, there's certain risks, some of which don't always meet the eye initially. And that's one of the things that we can do for investors is really take a look underneath the hood and explain what's going on. And to kind of start that off, for those of you that don't know, that are new to the 721 conversation, it's really a two-part transaction. It starts off with you selling a property and then doing what is, essentially a conventional 1031 into another asset, into a DST. The difference is that asset, when you're in a 721 vehicle, that DST that you're going into is usually on some type of schedule or intended route to find its way into a REIT. Okay, and that transaction is the 721. It's a tax-deferred transaction into a larger institutional holding in order to be able to move those funds in such a way that the investor would hopefully be able to then get the shares from that REIT and be able to liquidate, in theory, when they need to. And so, of course, there's a host of other things that come up there. But, yeah, that kind of addresses what it is and how that process works.
Yeah, so essentially what you're saying is someone invests in a DST just like any DST out there.
Right.
They complete their 1031 exchange, and then at some predetermined time frame, whether it be 2 or 3 years down the road, triggers a 721 exchange, which is the movement of the DST transitioning into the REIT vehicle, or whatever that 721 exchange vehicle is. And that exchange is for you selling your interest in exchange for partnership units
Exactly.
in that REIT.
So if you owned, say $1 million in a particular DST, then that's traded out for $1 million worth of shares in that new REIT. And then the question is, okay, well, who would actually want to do that? And what investor group would typically be interested in this type of strategy? And so the way it's often marketed is that this is an opportunity to gain some liquidity. And as most people know, these are private placements. They're typically illiquid assets because there's a management and business plan that generally is going to tie up that investment for usually on average 4 to 6 years. And so some folks will look at their portfolio and say, man, it would be really nice to be able to have the ability to grab some of those shares. And so in theory, being able to go into a REIT would then give you the ability to then liquidate and sell those shares back. And potentially, of course, you're going to have to pay your deferred tax. That allocated amount is going to come up. But you have the ability to possibly grab some of that. So that sounds attractive to a lot of investors.
So you're saying that these are not publicly traded REITs.
Right. And that becomes the catch right there.
And some investors might think these are publicly traded REITs.
That's right.
Because there's a big brand name that might have a publicly traded REIT.
That's exactly
right. But a lot
right.
of times where the DST is landing is not in the publicly traded vehicle.
Right. And it's not as easy to get folks to line up to buy privately held REIT shares. And so the idea that you could possibly just quickly and easily sell it as you would sell a stock, say, on a typical trading day, is not the case with these shares. In fact, you actually have to request redemptions, and most of the time the REITs, because they don't want to run on their shares, they don't want to have to have all this liquidity that they suddenly have to produce, they'll put a cap. That cap will typically be a certain percent, usually about 5% of the overall value of the REIT that's allowed to be liquidated or requested by investors to be liquidated. And so that does create a couple of things that you need to consider if you're going to consider, possibly rolling money into something like this. Number one, if you are looking for liquidity, just understand that they don't have to give you your money back when you ask for it. In fact, if a lot of other folks line up and are also requesting money, they might put you on a wait list. It might be 6 months, it might be a year, it could be indefinitely. They can also gate. And what does gate mean? That means that if there's too many requests coming in and they're unable to be able to raise the capital they need to be able to get that money back to investors, because remember, not only does this REIT have to support the operations of all the properties that are inside, but they're also having to pay out investors their monthly or quarterly distribution, and then also meet investor redemption requests. And so, as you can see, liquidity is always a little bit of an issue with REITs because of the way that the IRS is requiring them to be structured. And so if you have too many people asking for money, you can be in a position where they cannot always get you the cash that you're looking for.
Yeah.
And so, sorry, go ahead.
Yeah, no, I was going to, it popped my mind because I've heard the argument. In full disclosure, we offer 721 vehicles. I've even personally done one. And our goal here is just to encourage investors to diversify, not go all into this complex strategy because it is newer. There's not a lot of track record in the space where DSTs in general, normal DSTs, we have well over 2 decades of track record through different turmoil times over the last 2 decades. 721s have, in the retail space specifically, have only been a lot of times in the last few years. And so I think the next couple years is the real test on them, as they have, which we're going to talk about debt in a second.
Right.
But a lot of debt coming due this year, next year, 2027. But an interesting thing is why these are big. Some of these are pretty big REITs in the billions and billions of dollars. Why wouldn't they just be publicly traded? Are they afraid of being judged too much on what's going on inside the REIT, or what is going on? Why maintain the non-traded status?
It's a good question. I would say, the large financial companies have their reasons for wanting to do it. I will say that the requirements for filing and what needs to be reported with a publicly traded REIT are much more rigorous, standardized than the private side. And as a result, if you take a look at the overall track record and long-term value of those, there's a big difference between shares of publicly traded REITs and their private counterparts. And you as the investor need to understand that very important difference because at the end of the day, when you are completing a transaction from going from a DST that you own into a REIT, ultimately the day that your interest in that DST is cashed out and you move into the REIT, you get assigned a net asset value on those shares. Okay. And part of the reason why we kind of sounded the alarm around here was that we started getting phone calls from a good number of investors that had gone into these, and maybe they'd put $500,000 or $100,000 or maybe their entire exchange into one of these 721
Not
vehicles.
through us.
Right. Yes, that's that's a very important point. Yeah, we're big on diversification. We're really big on being, conservative with our funds and how we deploy them. And it's sad to hear those phone calls from investors where they piled all this money in only to find out that on the day of UPREIT, they were taking a hit. And their capital of what they put in, maybe they were getting, 82 cents or 85 cents when the actual UPREIT occurred. And that could be from a combination of a decline in the value of the shares. It can also be because of the fees that are charged when those transactions occur. There's a couple of different things, but as an investor, be aware of it. And so, yeah, that was one of the major issues that we realized, we need to go back, take a look at these things, inventory, do our own due diligence from better part of 2 decades of experience at looking at these, and try to offer some value for investors that are considering them.
Yeah, and so big one, liquidity, like Tim just gave an overview. And again, it might be a strategy for a piece of your portfolio. And there are some out there that are a lot more healthier than others. And that's kind of data we will show you. But I do encourage, there's 2 different strategies. There's one strategy where the 721 forces you, the business plan forces you. So no matter what, you're doing that 721 2-3 years from now.
Right.
And then there's some sponsors or institutions that will give you the option. I think that creates an alignment of interest because they need to maintain performance in that REIT so that when they come to you and say, hey, we want you to come up, you can then underwrite the REIT. A lot can change. A lot can change in a stock in 6 months.
A lot can change in real estate in 3 or 5 years.
Yeah. So, having that ability that even if you want to do the 721,
right,
at least in a couple years, being able to evaluate the health of that vehicle.
Exactly.
You should definitely evaluate the health now. There's
Right.
some big ones that you should just not touch.
Right.
And then let's pick the ones that might be healthier right now.
Yep.
And then have that option to decide in a couple years. With that said, I think the other thing that we've heard investors say is, hey, I like the institutional because institutional scale obviously sometimes creates lower fees, or at least that's what people are told. We oftentimes have seen some of these institutional vehicles that are being marketed as low fee deals, and everything has a fee, but low fee deals are actually some of the highest fees that we've ever seen. There's also some deals that are non-arm length transactions.
Right.
Actually, a vast majority of these big
Right.
institutional, meaning they already own the property. I'm just making a random example, but they own the property for $100 million that they
Right.
bought 9 months or a year ago or a certain period of time ago, but a lot of times not that long ago in a holding entity. And then they resell it to the DST for $120 million
Right.
or sometimes more.
Right.
And then claim there's no fees to investors when they just made a $20 million markup.
Yep.
So these are the things that our team, because it's very difficult in a 500-page PPM to dive through all that information
That's right.
as an individual investor,
Right.
so that you could truly make an apples to apples comparison. Again, there could be justification.
Right.
There may not be. And we want to understand that level and not just take something on the surface. That's what our analyst team is doing for people interested in that strategy. And hopefully you just kind of avoid those situations.
Right. After looking underneath the hood and getting a chance to actually look at the metrics on how a lot of these offerings are put together, it's eye-opening to see exactly how a syndication is done. And again, there are always going to be expenses when you are converting a piece of property into a security, let alone doing something like this. But when you start looking at the overall pie and the number of times that it has to get tapped into, especially to execute a fairly complicated transaction. I mean, taking something from, a tax deferral from a private piece of property to an institutional piece of property to a REIT. There's a lot of moving parts there, and that also means that there's generally a timetable that the IRS is paying attention to for the investor's sake, and to make sure that they're going to get compensated or not. The rules are going to be followed, and all along the way are checks and balances. Those are expensive too. And so when we crunch those fees, we look at the actual markups that are happening on the buildings that are being dropped down and turned into DSTs, and then the expenses when they are then sold and pulled back into the REIT. It's very eye-opening for most of our investors, to the point where what we have found is most of them decide, hey, wait a second, I can pick a curated selection of DST or offerings, or even 721s, right? That are
more traditional,
traditional, or just have a simpler fee structure or a more transparent fee structure versus a one-stop shop that maybe only gives me one or two options. And so I can customize a portfolio that hits several different investment objectives, is fee sensitive in a sense that, like, I'm not being charged extra for extra things I don't need or extra liquidity I'm really not going to be able to utilize. And you have something that can actually move forward and put you in a better spot 2 to 3, 4 years down the road, versus piling everything into a 721 vehicle where typically appreciation is not going to be as complete as it would with a regular traditional DST. And, the investor generally is going to find themselves in a better position after they've had the chance to do the research, listen to all the facts, and kind of build a portfolio that works for them in a little bit more succinct way.
Exactly. And to wrap this up, I have one more thing, but
Sure.
But I'll have Tim, before I close this out, we'll just make it very simple. And again, encourage everybody. We could talk about each of these things for a lot longer than we're talking, but for the sake of time, can you just go over the coverage of a dividend and how we're looking at that, and
Sure.
how that might be affected, and how there are certain, without names, but certain institutions that are just way behind, and hopefully they catch up, but it doesn't look good.
Right. No, and so an important thing to consider when you're looking at a REIT is to always remember that this is not a company managing 1 or 2 or 3 properties, okay? There could be 50, 100, 200 or 300 different properties, several $1 billion worth of real estate. And as anybody that's managed property knows, once you start, working with a property management company, at some point when you get big enough, you're managing them too, okay? And you got to pay attention. And so within a REIT, one of the things they're always looking at, and we're paying attention to, the industry pays attention to, is are they able to actually use real estate activities from the properties to be able to cover the distributions to the investors. In a simple form, you could say we're looking at the inflows and the outflows. Okay, do we want to know that the money that's coming in is going to be able to actually cover the payments that need to be made to the investors, the operational expenses for all of the buildings, and then also redemptions? Okay, because a lot of folks are using this for estate planning, right? And the whole idea is that if I was to pass away, my kid could then go and potentially request to get this money back. Well, guess what? When all those things line up and we have a lot of redemption requests on top of all the things that it is required to manage a portfolio of real estate, we have problems. And so this figure is called an AFFO, adjusted funds from operation. And we view this favorably to look at because we put a lot of stock in this because it tells us, is the REIT able to stay solvent and meet all those demands? And what we found after crunching all the numbers, especially post-2022, as we've seen a slowdown in real estate, is that a lot of these REITs are cash starved. They don't have the money. They're dependent on new transactions coming in. And so what does that make you as the investor? It means that if the REIT does not have the funds to be able to cover all their operations, which we're seeing a lot of right now, they're relying on new investor money to be the rescue capital to save all the different operations.
AKA the DST investors.
The DST investor.
And that might be why they're dropping a property down, because if they can sell a $120 million building to the DST, they just got $120 million of liquidity, in theory.
Plus the markup.
So, yeah, so these are things that, again, we want to be able to walk you through. A lot of this is factual because chunks, although there's certain things that aren't transparent, there's enough of transparency in these publicly.
And I don't want to knock it too hard because the reality is we do DD on these on the entire marketplace, and there are options that work. If you need part of this for part of your portfolio for estate planning, if you need a chunk of this for a liquidity need or a daughter's wedding, or you want to go buy a new performance car, and like this is something that is allocated as part of the budget that's coming up, let us know. Talk to your advisor, because we can go through, and there are options in the 721 marketplace where you have optionality, where you've got the ability to take a look at the AFFO and it's in a solvent, constructive place. The loan to value on the REIT is not all over the place. There are options out there. And I think that's why K Properties is so neat, because we're not going to just narrow that down to the one or two contracts that we have. We've got the entire marketplace to work with.
Yep. Yeah. And then the last thing I'd say about the 721 that for the long-term strategy that people need to be aware of is when you go into the DST, so let's just call it, for simplicity, it's a multifamily project, whatever the asset is. You exchange in that DST, when that REIT takes the multifamily into their vehicle, from a tax purpose, you are tied to that property forever going forward. Meaning, if that REIT at some point over the next 5 years, 10 years, 15 years sells that building,
right,
and does not do a 1031 exchange, hopefully they do,
right,
but if they do not, because maybe they needed access to some capital like we talked about earlier,
right,
and they sell that and don't do a 1031, all the original investors have a capital gains.
That's right.
You have a failed exchange to a sense. You still have your operating units in there, but
Right.
you're going to face that. And I have come across people in that situation,
Yep.
not our clients.
Yep.
So that's something. There's different protections, but most of them don't offer it,
Right.
Because it would hinder their business operations.
And if they do, they're short.
Yeah,
maybe 2 to 4 years.
What do we call that?
A tax protection agreement?
Yeah,
usually
tax protection agreement, which means that if there was one, if
Yep.
they sell and they cause a taxable event,
Yep.
then they will pay your taxes for you.
The
essentially,
REIT will cover it for you. Yep.
There's a reason why none of the major players have that, though, because it likely devalues your REIT value on the street.
Yep.
Having all these guardrails of what you can and cannot do within your portfolio,
Right.
Because it could, in theory, make sense to sell certain properties because
Sure.
there's better ways to use that money outside of a 1031, maybe a
Right.
massive development, or maybe to sell because liquidity saves the REIT value.
Right.
They don't have to worry about the original 1031 investors. And
Right.
believe me, the big institutions, they don't care about the little guys.
Yeah.
They're after their bottom line.
Right.
So it's something to be very aware of, and that's hopefully won't happen, and hopefully they will do 1031 exchanges inside and keep that peace in mind. But that's also why you want to diversify.
Yeah, diversify and
not
also read the fine print and understand. Like, before I get into something, especially if it's a 4/7/21 situation, if you are, middle age, later in age, and you're going to live more than 5 or 6 years, there's a good chance that you would have the ability to be in a situation where the asset that you were once in is now being sold. And if there's no TPA, yes, that can trigger.
Was it the Empire State Building? It was a big building in New York. Was part of a partnership that, like a group of investors, it might not have been the Empire State Building, but I think it was a notable building that was bought by a REIT. Then the REIT sold it down the road and caused a taxable event
and
for
then
all these.
triggered this for everybody else.
Yeah, that was like a famous.
Right.
There's something out there, so it can happen.
We're starting to see the industry respond. I know that Dwight has been very vocal about this. We've put this out at a lot of publications, a lot of media articles that he's obviously writing very regularly. He's brought it up, and we are starting to see it in certain PPMs from certain sponsor companies. But by and large, the larger 721 vehicles, this is not a part of it yet.
Yeah.
And it's something to be aware of.
So anyways, we appreciate everybody joining us today. Every Friday we do a new podcast, 11 a.m. live Pacific time, but we do record them all, so they'll be on the Apple and Android libraries and on our website. And visit kpi1031.com. We have lots of resources and look forward to meeting you all in person. Thank you.
Thanks, everybody.